Hello everyone, welcome to Yorkville's 3 Under 3 series, 3 slides on markets and economy in under 3 minutes. We hope you find this information useful, and if you have any questions regarding the content of this presentation, please do not hesitate to inquire with your relationship manager or by sending us an email. Please be aware that this presentation does not constitute any form of investment advice and is only reflective of information that is available to the presenter at the time the presentation is being made. The material presented is just for information use only. Please speak to your advisor prior to making any investment decisions.
Stock market prices and government bond yields often move together. Stock prices might fall as the economy slows, and bond yields might follow stocks lower. Or stocks might rise as the economy recovers, and bond yields might follow higher as the bond market prices in higher inflation and or higher central bank rates. In the case shown in Chart 1, bond yields fell while stocks rose during 2019. This is the bond market telling you, before COVID-19 hit, that something is wrong. And likewise, since March, the bond market is saying that this isn't a recovery. 8 months after stocks bottomed in 2003, 10-year bond yields had risen 140 basis points off their bottom, and bonds lost 9%. 8 months after stocks bottomed in 2009, bond yields had risen 140 basis points off their bottom, and bonds had again lost 9%. In the 8 months after stocks bottomed last March, bond yields have risen 32 basis points, and bonds have lost minus 2%. Not great, but not a sign of a recovery. Low bond yields continue to say something is wrong. Some analysts will say bond yields are as low as they are because of the Fed. I believe bond yields are as low as they are despite the Fed. In 2009, the Fed took rates to zero. If the Fed had done nothing after that, no quantitative easing or any other non-traditional monetary measures, then stock prices would be a lot lower than they are today, and so would bond yields. Chart 2 shows government bond yields in Japan, Europe, and the US. The recent Pfizer vaccine news has stirred the animal spirits of the market. Some analysts say inflation is coming and point to higher long-term bond yields and higher oil prices. But at best, a successful vaccine will move the needle from depression to recession. The underlying factors that have been at work since the late 1980s haven't gone away. There is just too much debt. Debt pulls future growth forward, and unless this growth is enough to pay down some of the debt, the problem just compounds itself. Lower inflation, lower growth, weaker recoveries as debt-laden companies are kept on life support rather than allowed to fail. The central bank solution has been more debt, which has only served to postpone the day of reckoning. The emergency fiscal measures in the face of COVID have been touted as being enough to fuel an economic recovery. But this feels more like the broken window fallacy proposed by the economist Bastiat. Bastiat talked of what was seen and not seen. A broken window stimulates activity as a glazier repairs the shop owner's window, and that is the thing that is seen. But what is not seen is the foregone spending that might have expanded the shop owner's business. We see money being spent on emergency measures. We don't see the government money that won't be spent on infrastructure or the reduced future borrowing capacity. Chart 3 shows high-yield bond spreads over risk-free government debt. This is the reward received for taking a chance on risky debt that might default and give you back pennies on your dollar of principal. The bottom chart shows small-cap stock leverage expressed as net debt divided by EBITDA. This shows the risk of junk debt. So the top chart shows the reward is very, very low, and the bottom chart shows the risk is very, very high. Investors have convinced themselves that this doesn't matter because the Fed. But I still think this will end in tears. We did invest in high yield between 2012 to 2015, but we still won't touch it today.
The information in this podcast does not constitute research or recommendation from any Yorkville employee or entities to the listener. Neither Yorkville nor any of its employees makes any representation or warranties as to the accuracy or completeness of the statements and any information presented in this podcast, and any related or associate liability therefore. The views presented in this podcast are not for any investor.